The debt service ratio, DSR, is a financial ratio that compares a company's debt obligations to its cash flow. The DSR is calculated by dividing the company's annual debt payments by its annual cash flow. Here's how you can calculate the DSR by first calculating the company's cash flow. Step 1. Determine the time period for analysis. Identify the time period you want to analyze. Typically, it is recommended to use a year as a time period. Step 2. Calculate operating cash flow, OCF. The operating cash flow, OCF, is the amount of cash generated by a company's regular business operations in a given period. To calculate OCF, start with the company's net income, which can be found on the income statement. Then add back any non-cash expenses, such as depreciation and amortization, and subtract any changes in working capital, including changes in accounts receivable, inventory, and accounts payable. The formula for OCF is OCF equals net income plus non-cash expenses, changes in working capital. Step 3. Calculate investing cash flow, ICF. Investing cash flow, ICF, represents the cash used or generated by a company's investments in property, plant, and equipment, as well as any investments in other companies. To calculate ICF, add up the cash used for investments, such as capital expenditures and acquisitions, and subtract any cash generated from the sale of investments or assets. The formula for ICF is ICF equals cash used for investments, cash generated from sales of investments or assets. Step 4. Calculate financing cash flow, FCF. Financing cash flow, FCF, represents the cash used or generated by a company's financing activities, such as the issuance or repurchase of stock, payment of dividends, and borrowing or repayment of loans. To calculate FCF, add up the cash generated by financing activities, such as loans and stock issuances, and subtract any cash used for financing activities, such as dividends and loan repayments. The formula for FCF is FCF equals cash generated by financing activities, cash used for financing activities. Step 5. Calculate total cash flow, TCF. Total cash flow, TCF, is the sum of OCF, ICF, and FCF. The formula for TCF is TCF equals OCF plus ICF plus FCF. Step 6. Calculate debt service ratio, DSR. The debt service ratio, DSR, compares a company's debt obligations to its cash flow. To calculate the DSR, divide the company's annual debt payments by its annual cash flow. The formula for DSR is DSR equals annual debt payments, total cash flow, where annual debt payments equals current portion of long-term debt plus long-term debt. Time period of analysis. The time period of analysis should be consistent across all cash flow items to ensure accurate results. A DSR of 1 or higher indicates that the company is generating enough cash flow to meet its debt obligations, while a DSR below 1 indicates that the company may have difficulty meeting its debt obligations. It's important to note that the DSR enough cash flow to meet its debt obligations, while a DSR below 1 indicates that the company may have difficulty meeting its debt obligations. It's important to note that the DSR is just one factor to consider when evaluating a company's financial health, and other factors such as profitability and liquidity should also be taken into account.